Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Cut to the Chase. Now, financial markets woke up to some fairly significant geopolitical events related to the ongoing crisis in Ukraine. As you may have already read, Russia said it moved to recognize two separatist regions of Ukraine, Donetsk and Luhansk, as independent regions and ordered Russia's military to enter these areas on peacekeeping missions. Now, while the move has triggered condemnation by European and US policymakers, interestingly, it remains unclear whether it meets their threshold of a Russian invasion of Ukraine, given Russia has previously deployed its military to this region before. How US and European policymakers react specifically is something to watch closely as we go through the market day today and indeed later in the week. Now, the response in financial markets held no surprises. Equity futures were down and oil prices were up. However, today I want to talk about the Japanese yen, as we believe this currency can offer one attractive hedge should risk appetite weaken further. First, a bit of long-term context. We know the Japanese yen is popular as a funding currency when times are good, but it's also well known that the yen is a safe haven when risk appetite fades. As many FX traders know, these moves can be large. A recent paper by the IMF, for example, documented 3 examples of the yen appreciating anywhere from 3 to 7%, sometimes barely within a month. Now, today, the Bank of Japan's efforts to keep bond yields capped has extended its attractiveness as a funding currency at a time when bond yields in the US and Europe and indeed many emerging markets are rising. Having said that, the currencies also now become very inexpensive on valuation grounds, and a lot of near-term technical indicators are oversold. Now, in our view, this sets it up well as a hedge should risk appetite take a sharp turn lower after Russia's latest move. Now, recall that we view geopolitical risks, broadly speaking, as usually having short-lived impacts on financial markets, and in our view, that makes adding a hedge, like the yen, a more attractive position for portfolios rather than trying to cut back on what are meant to be long-term equity allocations. Now, the dollar-yen pair is one way to implement such a view. The USD-JPY pair specifically has struggled at resistance near 116.5 in recent weeks, which we believe opens up room for a move to the downside. Now, there's strong support for the pair in the 112.5 to 113.5 region, which we believe should limit any initial surge lower. So that's one idea. Another way, of course, is the euro-yen pair, which is another candidate we believe to implement a risk hedge view. This is where we've also opened a trade in recent days because the pair has dropped below its 200-day moving average. We expect a move towards 125, which is below its previous low of 127.4. So 2 ideas for potential hedges in what's turning out to be a geopolitical charge week. As a reminder, please do take a look at our daily FX Navigator publication if you want to look for specific levels for the yen pairs or any of our open trades. So with that, I'll take a pause there. And as a reminder, if you enjoyed this podcast, please don't forget to rate and like it. Thanks again for listening, and we wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.